All right. Welcome.
Thanks for having me.
So this episode today is all about taxes, and we met at a business planning clinic because you work with Jeff Baker and Associates as a tax professional, and I was like, can you be on my podcast? And you're like, funny story is, so tell a little background story about.
Yeah, so I actually started taxation. I got a degree in professional accountancy, graduated in 2012, but of course did internships and everything before then. The fun thing is that I actually started as kind of like a music psychology major at Whitworth University.
Okay.
I found out though very quickly that I was kind of turning my passion into work. And I truly believe that you want to turn your work into passion. And so I took an accounting class at Whitworth. They weren't accredited in business at the time. And so I took this accounting class, and I'm a middle child. So this teacher goes, who here is an accounting major? A bunch of people raised their hand, and I was just a general business. And she goes, by the end of this, you won't be. And I was like, oh, tell me more. Exactly. So the really cool thing is that the final for that class was actually playing Monopoly, which in my mind is genius. Because we start to learn that accounting and taxation are in everything.
Yeah.
I mean, every single thing that you do, it's a trade-off of money versus, things that you get. You go and you buy a new bottle of perfume. Well, you lost some money, but you acquired a perfume that adds value to your life. And so that is essentially the basics of accounting. So I then graduated, switched schools, went to Oklahoma Baptist University, big switch, and did a bachelor's of professional accountancy, and I have just been stuck ever since. So I've been in practice for about 15 years.
Okay.
I really started getting a passion for taxation when I joined my first public accounting firm. And that's because I got to do a little bit of everything. But what I love about taxation is it's a puzzle. And so your situation may look like another person's situation, but that doesn't mean that they're actually going to actually be the same. And then the problem with TurboTax is if someone says, hey, I've got 2 dependents and I have some income and I have some interest, and their buddy has the same thing. One of them may get a refund and the other one may owe. Then they don't have that person to rely on to talk about why that's the case, why those are actually not similar situations, even though they sound the same. So it really instilled this passion for me to figure out puzzles and people's unique tax position so they can best take advantage of their portfolio. The IRS does require you to pay the minimum taxes due, and I always tell people that your idea of minimum and their idea of minimum can be 2 very different things.
Yeah.
But it doesn't mean that your stance is wrong. For an example, military specifically, which I know is what we're here to talk about today, it actually came because my husband is a 100% totally and permanently disabled veteran. So he was a military brat growing up. His dad joined the military to get out of Puerto Rico. He then joined the military when he was 18, and what I have seen by being in a relationship with him and by being married to him and living that life is that for the most part, especially lower enlisted, and even some of our officers, they tend to rely on the free H&R Block TurboTax type services.
I know for a fact that that's.
And the other problem is though, is that military is such a niche kind of area that most firms don't specialize in it either. So I see kind of the military industry as a whole, our service members who are out fighting for our freedoms, keeping us safe, they tend to be some that don't get serviced as well for everything that they do. So part of my own practice has been that passion of making sure you guys are aware of the tax laws that are to your benefit and the way that we can leverage them to really capitalize on that minimum amount of taxes due.
Oh, I love it. When do you think would be the best time to hire a CPA versus doing that TurboTax? I know we right before we hit the record button, I was like, let's talk shit about TurboTax. And you're like,
I have words. I have a soapbox.
Got it. But when would be the best time for someone to consider it? What unique situations?
So ironically enough, military has some unique niche tax laws that I'd say that as soon as you get your first pay stub, as soon as you get your first W-2 from the Army, from the Air Force, from the Navy, from the military, from DFAS, that there's never a bad idea to have a conversation with an accountant who is knowledgeable in military taxation. Part of that rule is I'll use my husband as an example. He for the most part, he claims military or Florida is where he grew up, even though he was born in Georgia. His dad was in Germany. He was in Germany. whole bunch of fun things. That being said, Florida does not have a state income tax. However, Georgia does. And so as soon as you get that, there's actually tax laws and rules that impact a service member's filing. Fun facts is that, well, Florida, of course, you're going to go to your home of record for tax purposes on Florida filing. No income tax, may as well file where there's not going to be that additional impact to you. There could be other service members who came from Georgia, Idaho, Oregon, which do have income taxes. There are rules right now that state that you can choose to pay income taxes on your home of record, your permanent residence, or your station. So if we have service members who are coming to JBLM, for example, Washington doesn't have an income tax. They may have income taxes back home, even though not all states tax military pay. Sorry, hit the mic. Not all states tax military pay. But, for example, spouses could elect then to have Washington taxation. They no longer have income taxes in Washington state. So there could be an opportunity to have conversations, depending on the state you're in, with a CPA at that moment, because there could be opportunities to avoid state income taxes, even if it's not a benefit for federal. So I'm always saying, worst case scenario, go and have a conversation. Usually, at least my firm does not charge for those first conversations. Be informed, and then worst case scenario, you do the unfortunate TurboTax thing for a few years. Though if I might put my own little 2 cents in there is for those people who want to kind of do it themselves, there is a tax service called freetaxusa.com.
Okay, I'll be putting it up on the screen.
Yes, federal is always free. The state is $15. It was actually designed by CPAs and the people who code our tax software, just as user-friendly as TurboTax, but it's a little bit more fair to the taxpayer, civilian and military alike.
Oh, perfect. Cool. What are some of the loopholes? I know when we had our first initial conversation, you had talked about renting your house out on do those things apply to military? Because you said one of my passion projects is helping military because of your background, your husband's background. What are some of those little tidbits where you're just I just wish I could shake these service members so that they know that they have these benefits? I'm gonna have to pull your mic just a little bit closer, just in case.
Just so I can hit it some more? Got it.
You can always adjust it up.
So first and foremost, one of the things is we saw a huge tax kind of change in 2018 when Trump came into the office. Tax Cuts and Jobs Acts, it got rid of exemptions, it got rid of those limited reimbursable expenses for your job, and you pretty much doubled the standard deduction. So now you've only got 4 main, arguably a few extras, but 4 main components of an itemized tax return. Military or medical expenses, if they exceed 7.5% of your adjusted gross income. Okay. So most people don't get that unless it's a heavy medical year. Huge illness, cancer, death, birth of a child, heavy medical years. Usually that's when you're going to get that medical to go towards itemization. You have your taxes, which with the Tax Cuts and Jobs Act was limited to $10,000. Mortgage interest, which is now capped on a home acquisition of $750,000, or charitable donations. Most people stopped itemizing, and especially during COVID, they didn't have the interest to be able to itemize. Things that military still get, though, that don't require itemization is those moving expenses. You get PCS orders, you have to move, you're able to deduct those as another adjustment to income outside of itemization, which is going to reduce the taxability of your income. And if you're not tracking those forms, if you're not tracking the cost of getting a trailer, the cost of lodging, the cost of fuel or mileage, and mileage this year is 65.5 cents. Wow. It adds up, right? Yeah. Most stations we PCS are not within the same state. We're talking state changes.
Oh yeah.
So those can really kind of add up. Of course, those expenses do have to be unreimbursed. So always do kind of the weighting of, is it better to move with the military, which at least from my experience typically leaves 50 to 60% of your stuff broken and dented, or do you move yourself, in which case do we have reimbursements in excess of, or costs in excess of those reimbursements. that's where we get to have those extra deductions to reduce AGI.
What about food?
Unfortunately, meals are not included as part of that because they want to have it be the moving of the equipment, not the moving of the people.
Got it.
So unfortunately, that's not included in that expense, but it is good to know and kind of track. Likewise, and I want to get to the real estate here in just a minute, but these are kind of fun little ones that some of our lower enlisted can pick up. If we have reservists, for example, they can actually deduct their military uniform still, again, not requiring to itemize, so they don't have to exceed the 20,000 plus or 13,000 increase in the itemization. So most people lower enlisted say they just started, they're doing those first moves. Maybe you've got a reservist who had to purchase some uniforms. You don't have to exceed your itemization, which for an individual who's not married is $13,850. So they can reduce their income, they still get the standard deduction. That can save them some money, even if it's, couple $10, $20, it's still money they don't have to pay. So reservists get to still deduct their uniforms so long as they are not required or they're not reimbursed and they're not allowed to wear them outside of their service. And if they're ever required to travel for training, they also get to deduct that as another adjustment to income, not restricted to a standard or an itemized deduction, which is great because nobody else gets that.
No one does.
When we start talking about utilizing military benefits, a lot of them are in fact tax-free. And of course, as you know, our wonderful realtor here, we have those VA loans. We have actually quite a few VA opportunities. Speaking from my own experience, when my husband got out, we got a VA loan in a home in Florida. We had it was a 4.25% interest rate back then. And then of course, COVID happened and we had already turned it into a rental, but I was able to do what's called a VA IRRRL, which is an interest reduction rate kind of loan, a VA IRRRL. And what I was able to do is take that 4.25% interest rate and turn it into a 2.25%
You're one of the
interest
lucky
rate.
ones out there right now.
Oh,
You'll
yes.
never sell that property.
Oh, I did. I actually did sell it,
Wow.
which I am lucky still because it flooded the next year because it was within 5 miles of the beach in Florida.
Whew.
So I'm thankful that one's gone, but my primary residence is also 2.25% on a VA loan. I didn't have to do a down payment. I have this beautiful interest rate that I am never moving out of that house or I'm never selling it just because you can't beat that rate.
No.
So what I really like about it is that when we start talking about these benefits, when we start talking about these loans that are available to the military, we also can start talking about some of the tax laws that are available to the military. So obviously in the military, you don't get to stay in the same place for 5, 10, 15 years. If you do, you're really one of the lucky ones and you're probably on your way out. And so what we start looking at instead is how can we utilize these loans, which require zero down payment often, and the tax rules to really start building wealth within the military. You guys have great opportunities. You have BAH, which isn't taxable. That can pay your mortgage.
100%.
You can, you have different stipends, non-taxable combat pay, which also has some fun tax loopholes to build wealth and create investments that you can pull on tax-free. So with that in mind, for example, you come to JBLM, you purchase a house, you're living in that house, even if it's a slightly ridiculous interest rate right now, you get to live in that house for as long as you're here, 2, 3, 4 years, you get your PCS orders, you don't have to sell that house for it to be non-taxable. You can turn it into a rental. Rentals typically are not going to be taxable for at least the first 3 to 5 years, just because due to depreciation, which is like the wear and tear on the building, you're not generating a profit. And if you're at least actively participating in it, and we can get into this, you could actually use that loss to offset some of your income.
Yeah.
Another great opportunity.
And one of the things that I absolutely try and keep telling everyone is that you can buy a multifamily home with your VA home loan zero down. And so you will have those other units paying for offset it. So instead of paying for the entire mortgage like a single family home, you're getting a little bit of a break. And some of these multifamily, I'm personally possibly writing an offer on Friday on a multifamily home with my VA home loan.
Yeah.
And I'm sitting there like, well, instead of paying $3,600, which I would be responsible for, they're going to be paying $1,750 of that, which now makes it a little bit more palatable.
Absolutely.
So I always tell everyone, and then now you're talking about all these tax benefits that you can have by being a landlord, which continue.
Yeah.
I just had to go into my soapbox.
No,
one of the things I'm so passionate about. Like, please, if you're a younger active duty or an officer and you don't have like the family, or even if you do have a young family, sacrifice a little bit. Live in a multifamily home on one of the units, and then utilize that to build generational wealth.
Absolutely. Well, and as you know, most of our lower enlisted are going to be sharing walls with other individuals anyways.
Yeah.
And what a lot of people don't, and of course the loan officers are better people to talk about this, but what a lot of people may not always realize is they look at their income and they say, I can't afford a home. When in reality, if you're looking at a multifamily, if you know that you're going to be renting it out, you can use that theorized income to actually qualify for a higher loan than you might have originally been able to.
Yes.
So there's a lot of great things that come with that. But let's talk about what a rental entails. So when it comes to taxes, what we're going to be looking at is the actual net profits. And net profits is your income after all the expenses that you had to spend money on in order to make that income. So in order to keep a rental, you're going to have to pay a mortgage, and there's interest on that. That's tax deductible. And unlike your primary residence, which is going to be restricted to that $750,000 limit to even take any mortgage interest for itemization, you get to dollar for dollar reduce your rental income by that mortgage interest unrestricted. Even if you happen to qualify for $1 million property, you get the full interest to the portion that's used for rental. So if we're talking a duplex or a fourplex, take the mortgage, divide by 4, keep a quarter to yourself. The rest is all deductible, regardless of income. Yeah, and the portion that you're using still goes towards itemization. So it's great. On top of that, real estate taxes, you got to pay your property taxes or they're going to levy your house. If you end up paying utilities, you get to take that expense. If you pay a CPA, you get to take that expense against that income. Repairs and maintenance, HOA fees, security, all those things required to have that property all becomes deductible. And then we have depreciation, which is just, again, the wear and tear over the life of that building that you get to deduct. It's not actually a cash outflow. You didn't spend, $6,000, $7,000 for the building in that year, but you still get that benefit. And that helps bring that deductibility or the taxability of that rental down to zero or even a loss.
So, question for you. For taxes for, let's just say, a single family residence, or even, let's say, an E5 who purchases a house and they have a wife and maybe 2 kids, and what would be the difference between like the taxes of them just living on base compared to maybe living in a multifamily home? Like what kind of differences would you see?
So this is where we start talking about that active participation. So if they're living on base, they don't have mortgage interest, they don't have real estate taxes, they're pretty much just having their BAH taken to live on military housing. They'll have a W-2, and assuming that nothing else is really going on, exemptions don't exist anymore. So unfortunately, the kiddos mean less and less each year. But they probably have, depending on their withholding, a slight refund, maybe a healthy refund, but that's it. It's a fairly straightforward tax return. Go ahead, use freetaxusa.com.
Yeah.
When we have a E5 who's purchased a duplex, now they have a rental schedule that can generate up to $25,000 of losses that they can reduce their income by. That is $25,000 that on top of the standard deduction, they don't have to pay money on. They do have to actively manage it. They don't have to meet real estate hours like you do as a real estate professional, but they're able to take that $25,000 loss and offset the income. Of course, it's taxed, so there's always hiccups, so we'd always be able to talk about that. But it allows them to now start leveraging their portfolio, leverage the rental to cause this reduction. On top of that, if we think about equity-wise, you've got your tenant who's probably paying the full mortgage or at least a healthy portion of the mortgage. Your BAH takes care of the rest. Now you're suddenly building wealth because not only is the home appreciating, but they're also paying down your loan, which gives you more equity in the property. That's how we start building that tax-free wealth. That equity in that property through the appreciation and payment of the loan, it's not taxable at all until the property is sold. And we can get into that too.
Okay.
But it's really great because now we are creating that generational wealth for the kids. If something unfortunate was to happen, because let's be honest, military.
Pause.
It attacked me. It's tired.
This
it's okay.
thing, I swear. Good thing I can edit this.
I was going to say, I know taxes can be boring. I thought I was doing okay.
That'll be a great bloopers of your
Taxation's so boring, even the mic gave up. It's okay.
I'm gonna pause it. Wow, that's going in the blooper reel for sure.
Like I said, taxes aren't for everybody. You know, I'm one of those weirdos who became passionate about it, and now the microphone obviously is not passionate about it. It's okay.
Move you down just
Love
a
it,
little
love
bit
it.
so
There we
that
go.
can
See
your
my face.
There we go.
Love it. So as I was saying, the rentals are really great because now all of a sudden we've got someone who, you've got an E5, you know, they're making their money. They could have close to $40,000 that typically would be taxable, suddenly not taxable.
Wow.
That's a big difference.
Huge.
We could even talk about how if you had your kids, for an example, this is not a military tax law, but it's where we start talking about leveraging your portfolio. So of course you're living in a duplex. Maybe if your kids go over and weed the garden just to make sure that it continues to look nice. Well, now you're able to have your kids pay your children for their services on the rental property. That's tax-free money. If your kid's less than 17 years of age, you don't have to issue, taxation to them. They don't have Social Security, they don't have Medicare, they don't have to pay into federal unemployment taxes, but you can start using that also to maintain the property, pay the kids, and you could put that into a 529 plan, for example, which is going to pay for their education in the future. If you don't have something, like 100% total and permanent, and you have chapter 36, I think it's 36, 31 benefits that pay for their education. But the other great thing is about 529 plans too, using this rental property or property management business, if you get multiple properties, would be that now you can start building for your kids' future. 529 plans also can be used to purchase their first home.
Wow.
And it can be turned into a Roth account, which again is tax-free on distribution so long as it's held for 5 years and they reach retirement age.
Now, question with that, do they have to create an LLC in order to do that, or is it just purely under their name and then they own this property, they have kids under the age of 17, they say, go to work.
Yeah.
What does that look like? How do they have to calculate their hours at the end of the year when they sit down with a CPA? Can they help them build that spreadsheet?
So I actually have a log already developed for our clients for them to kind of manage what the kid did. Obviously lawn care, it's not going to be $1,000 a month for lawn care. I pay my lawn guy, who's very obviously not my kid, $280 a month. And he comes out and he mows and he gets the leaves raked and he pulls some weeds in my flower beds. So what I would say is that I would keep track of the log, and as long as there's reasonable pay there, that's sufficient evidence for a CPA to be able to look at. We are allowed to rely upon any person's information so long as it doesn't contradict what is being shown. Obviously we have our ethics that we have to follow, and we have to make sure that we are vetting this information, but so long as things are consistent and you show that you've done the work to kind of track those, you're good to go. You do not need an LLC to pay your kids though. So long as it is a parent employing a child of theirs under the age of 17, we have the ability to pay our children for their work that is done. So options for that would be, sole proprietorship, which is what these businesses default to. If you don't have an LLC, you have single member LLCs, which also default to sole proprietorships for tax purposes. And I do encourage LLCs for rentals, and we can talk a little bit about that. But of course, there's going to be the caveat of always consult an attorney, because I am not an attorney.
Yeah.
And then, of course, you can have partnerships. So say, for example, 2 veterans, maybe, or even brothers or sisters, family members want to go in and get a multi-resident property. That would default to kind of a joint venture or partnership. They would be able to have both their children assisting with those properties. As long as it's not an S-Corp, it's very easy to pay your children. If you have an S-Corp, there's still opportunities to, but it just takes a little bit more where we have to start talking about family LLCs, potentially management of children, where the S-Corp doesn't get to pay the children directly.
So would you recommend, so let's just say it's that scenario again, that E5 with their 2 kids under the age of 17, and they have a duplex.
Yeah.
Now, would you just create a little separate bank account for those kids so that you can track that money? So it's just basically chores on steroids that you get to now benefit in.
Yeah, you get to say, hey, I have two tiny human beings myself. My 5-year-old loves going out and pulling weeds. So if I sent her outside, say I had a duplex, I sent her outside, I said, every Saturday I need you to go out and I need you to pull the weeds in the flower beds. I can put that money into a savings account or a 529 plan for her, track, hey, she spent 2 hours going and pulling weeds out of the flower beds. I chose to pay her $100. That is now an expense to us, and it's tax-free. It allows me to start building wealth for her.
Wow, and that's really incredible, even like a lesson for your kids so they can see the bank account, like, well, you did get paid to do this, but I'm taking rent out, I'm taking all of this stuff out. That's a really good information.
Yeah.
You also mentioned something in regards to renting your house back to yourself.
So you are able to rent your home out for 14 days a year. It's called the Augustine Rule. So you're able to rent your house out for 14 days a year. This is typically not going to apply for an expense to a rental property. It has to be only 14 days a year. So for example, if you had an E5 whose spouse was doing some, maybe she does one of those MLMs. She does Young Life, she does, or he does, because not all spouses are female.
Sure.
So if your spouse is doing, one of those kind of direct sales, if they had parties at their house, for an example, they could then utilize renting their house to that business up to 14 days a year. Again, it's an expense for the business that the spouse is working through, and they don't have to pick up that income anywhere else. It is available to all taxpayers as well. So again, if I wanted to take my tiny human beings to Disney World and I wanted to rent my house out for 14 days, I could do that. I live on a lake, and so I could theoretically rent my house out for $1,000 for 14 days a year, and I don't have to pick up $14,000. I'm showing that I rented it through Airbnb, and because it's 14 days or less, no income's picked up. When you have a business outside of a rental, you're then able to use that Augustine Rule to rent your home to the business, reduce the business income, it reduces taxability, and you don't have to pick up that income anywhere else for tax purposes. So that's where we have those kind of rentals, but you cannot use that same property for rent, because as soon as we get to 15 days, all of that income becomes taxable.
Got it. Okay. That's really cool. So what would back to that scenario before our mic decided to yeet itself off the table. We were talking about the difference of that E5 and their family and what it would look like if they had the rental compared to not. What would their tax return like?
Yeah,
I know that you can't without specific
numbers. But it's difficult, but I mean, essentially, let's take the $25,000 or $20,000 of losses. Say we generated even $10,000 of losses, and if you're in a 22% tax bracket, well, now all of a sudden those $20,000 over $10,000 of losses is going to equal a tax savings of over $2,000 because you get that loss at your top tier tax bracket rate. So if we're in that 22 percentile, now all of a sudden we could be dropping ourselves down to a 12%, which is the largest jump in our tax bracket rates, is the 12 to 22%, 10% jump. They could have a significant refund at that point if we had that full 10,000 and 22%.
Wow.
So it's not chump change when we start thinking about this. I can think of a lot of things I could do with $2,000. Mm-hmm. I mean, that's groceries for just about a month. Yeah, I mean, if you shop at dollar store, no, I'm just kidding.
We joke about inflation, but it hurts our soul.
It does. It really does. So, I mean, going to the grocery store and having a pound of meat and some potatoes and having to pay $200, that's not fun. But if we had that extra coming back to us, that could be a mortgage payment or a partial mortgage payment. That could be groceries. That could be quite a bit that you're getting to put back in your pocket rather than having it go to the government where we don't always see the benefit come from.
Exactly.
So that would be, I mean, we could have some pretty significant savings that come with that. In order to get that loss, though, we do have to have that active participation, and I've talked about that a few times. So what that is that you need to show that you didn't just pass the property off to somebody, that you're not just sitting by and letting them collect the rents for you, manage the tenants, manage the issues on the property. You have to be involved in it. So again, with taxation, always have a log. As long as you have a reason for why you did what you did, usually there's something defensible there. But again, consult a CPA to make sure that we do have that appropriate defense for the positions that you take. So what I would say in this instance is that, we would want to be looking at how did you call multiple lawn people to determine the rate that you're going to pay your kids? Did you have to call a couple pest controls because there's mosquitoes around here and you want your tenants to be able to go and enjoy the back doors, outside, back door, backyard. So now all of a sudden we've got these hours spent calling 2, 3, 4, kind of pest control people to track that. Maybe you had to go and have your roof demossed because again, it's a little cold and a little wet around here. And so we got moss that grows on our roof. So maybe you had to have someone come and clean that, pressure wash it, but you probably called people.
Yeah,
now,
please do not put your 5-year-old on your roof.
Yeah, that would probably not be good. Mine would probably think she could fly. So let's not do that. Let's not do that.
Those are some of the things that you do professionally hire out.
Yes. But if you got a 15, 16-year-old, I might put them on the roof. Mine are girls though, so I think there's less risk of them jumping off just to impress their friends. So of course, always use a modicum of consideration for your child and for their personality. But spending those times to find the professionals to help you maintain your property, vetting your tenant, making sure that the property looks good. All these show that you're actively participating in this rental. That's how we can get up to $25,000 of losses being allowed to be utilized against other sources of your income.
What if you are paying a property management company? Because for some who do not have rental experience, they, in order to be able to supplement their income, to be able to qualify for more, if they don't have 2 years of a landlord experience on tax return, they don't get to utilize that. They have to hire a property management company. So would that, obviously you can end up firing them right when you get your house. Like there is that. But if they continue using it because they are out of town and they don't want to deal with it, can they still have the same benefits?
Yeah, so you still could be actively participating in your rental even if you're not the property manager. Okay. That's going to be still you vetting the tenant. So you just let your property manager know, hey, I'd like to review the applications and pick some of my favorite ones before you just hire it out to somebody. Sometimes they're willing to let you do that. I know from using my own property manager, because when my property in Florida turned into a rental, I had to have a property manager there while we were kind of getting situated over here. I needed someone to have eyes on the property, and I can't do that from Washington. Yeah. And so in that instance, it was me approving repairs and maintenance. It was me managing the books. That's active participation within the property, because your property manager doesn't know the interest you pay on the mortgage. They don't know your real estate taxes. They don't know your insurance that's on the property. And they may not even be aware of, I ended up hiring my own lawn guy for each of my properties because I wanted to make sure that the tenant wasn't going out and scalping grass, for example. So all of those things still qualify for the active participation. But again, you have to show that you are trying to make an effort to be involved to some extent. Even if it's not you just collecting the rents, you can still have that property manager.
So record, which is basically the military already hones that in. But if you're a spouse watching this, which I know a lot of spouses do, because they're the ones that are managing the funds of the house, just keeping a record, just keeping a spreadsheet. And you said that you have spreadsheets. So if you are interested, comment below and I will send that. There'll be a little link and you can click on it and get those forms. I will send those out to you. What other things?
So the other really fun one, and this kind of goes back to military taxation specifically. So usually if you're a civilian, there's the homeowner's exclusion. Everybody knows and loves it. They may not fully understand it, but it's the exclusion that if you live in the home 2 out of the last 5 years, you don't have to pay capital gains up to $500,000 for married filing joint or $250,000 for single individuals. You don't have to pay any capital gains on those. You get to exclude those. So I think about, for example, again, I'm going to go back to my Florida property. I purchased it. I actually had it built for about $200,000. I sold it for $400,000. That's a $200,000 gain, and I didn't pay any tax on it because we made sure we fell within that homeowner's exclusion, even though we had turned it into a rental. There's always going to be a little bit of pickup on that depreciation, that wear and tear that you've been benefiting from. The government says you have to pay some of that back. So we had a small gain of about $30,000, and we paid 15% on that. That's less than $5,000 that we paid taxes on. But I had $200,000 of income that I did not have to pay any taxes on. Because my husband is no longer in the military, we had to fall into that civilian 5-year rule. Military has 15 years to qualify for that exemption. So that means that you purchase a property, and I actually just defended a case a few years ago in Hawaii. We had a service member who was PCS'd into Hawaii. He lived there for about 3 years. He left the state on PCS orders, turned the property into a rental. 10 years later, chose to sell it, and Hawaii came back and said, you owe us $40,000. And we were able to say, nope, he is active duty military. Here's the PCS orders that showed him coming in, that showed him coming out. By the way, you can't tax his wife on any of the income that she also earned there because of the Military Spouse Residency Relief Act. So we were actually able to go back and not only get rid of the $40,000 tax bill from Hawaii because of that 15-year exclusion, but we also went and petitioned them for an amendment that allowed them to also recapture some additional money from income taxes that the wife had incorrectly paid to the state.
So basically you're saying is sell it if you're going to plan on selling it before you get out.
Absolutely.
So you fall into that 15, otherwise it will revert back to that 5.
It will.
And then second, can we talk about 1031 exchanges?
Absolutely. So 1031 exchanges, again, not military specific, but what's great about it is that we can kind of kick that tax ball down the road. So if I had wanted to, and my husband and I weren't quite sure where we wanted to purchase in Washington State for rentals when we sold our Florida rental, but if I did not want to worry about that $200,000 exclusion, maybe we kept it a rental for 1 more year and then we didn't qualify for that exclusion. $200,000 is a lot of money to pay capital gains on.
A lot.
So what I could have done is what's called a 1031 exchange. And that means that I take the sale of the Florida home and I put that money into another residential real estate or another real estate type investment, and I'm able to then exclude those capital gains for the time that I own that property, or at least until I get rid of the property that keeps kicking the ball of taxation down the road. You can 1031 a property that was 1031'd into, and it can just continue to go so long as the tax law is there. There's also other types of investments like a Delaware statutory trust, which allows you to receive income without having to do the landlord responsibilities. But again, you have to have that rental first. So let's talk about the basics of a 1031 exchange, because that was a lot of information.
I know, I was like, I'm in the industry, and I'm like,
There's a lot there. So you purchase your first rental, and you love your rental, but maybe you get tired of paying taxes to Georgia. So what we do is we sell that property through an exchanger. So you don't ever want it with taxes. If you don't have to touch the money when you're moving from retirement account to retirement account or rental property to rental property, if you don't touch the money, the IRS is going to be happiest. They just don't want to pretend like you saved even $1. So we go through an exchanger, and they will take the funds at the closing, and they will help you find a new property to purchase into. The great thing about a 1031 is, let's say that your property appreciated and it's, again, 200,000 turned into 400,000, but you don't want to have another $400,000 property. Maybe it's not the right area that you're looking at. Maybe your ideal tenant can't afford the rent on a $400,000 property. So a 1031 will let you take those funds, and through the exchanger, you could purchase 2 properties. You could purchase 3 properties. You could purchase a lot of different properties. You could put it into a duplex. But they take that money and they're putting it into a new property, and because you didn't touch the dollars, you're able to therefore exclude that gain from your taxes for that year that it happened.
Yeah, and there are some caveats. You do have to, as soon as you sell the property, you do have to identify the new property within 45 days.
That is correct.
And
you have to close within 180.
So just identifying that's a whole other podcast in itself.
That is.
This is a tax podcast, so we'll continue talking about the taxes.
Well, and 1031s, again, that could be a great, there's a lot of opportunity there, because you talk about identifying a property in 45 days from the sale of your original one. Well, there's ways to do, for example, a reverse 1031 exchange, which is where you identify the property before you ever sold the first one. And you're able to kind of go back and do that. 1031s, simplistically, is you take one property, you put the savings into, you take the gain and the price of the old property into a new property. Like kind for like kind. You change dollars for dollars. Simplistically, that's what a 1031 is.
Yeah.
But we can get a lot more complex by using it to develop land. We can get it more complex by talking about finding a rental property. And it was, thinking back to 2020, if you waited to sell your other property, you were probably going to lose the property that you wanted. So there's ways there where we could have done like a reverse 1031 exchange, or again, we can start creating more properties to have that opportunity of real estate growth by this 1031 exchange, using the money you've gained through paying down of the principal and appreciation of the property to really just start expanding your investment portfolio.
Nice. So the moral of the story is every military person should own a house if they can.
Agreed.
They should own a multifamily home and keep it. And if they want to, what's the word I'm looking for?